Hoarding debt is a real worry. If you're an investor, you start wondering what's going to happen and whether there's going to be debt default.
Federal budget is on an unsustainable path.
We're going to be broke really quickly unless we get serious about dealing with our spending issues.
Will China hit back at Trump's tariffs, selling U.S. treasuries, U.S. bonds basically?
The big question is, at what point does the bond market break?
Something's breaking in the global financial system, and most Americans have no idea it's happening. Between September and January, foreign governments sold over $100 billion in U.S. Treasury bonds. At the exact same time, the Federal Reserve was cutting interest rates. Here's the crazy part. When the Fed cuts rates, borrowing should get cheaper. Instead, it got more expensive. That's not supposed to happen. It's like turning down your thermostat and watching the temperature rise. Here's what's really happening. The world is quietly walking away from American debt. And when that happens, everything in your life gets more expensive. Your mortgage, your car loan, your groceries, everything. I'll explain how we got here, but first, you need to understand what American debt actually is. For nearly a century, American debt has been the safest investment on Earth. Here's how it works. When the U.S. government needs money, one of the ways it raises funds is by selling bonds. Think of them as IOUs. You give the government $1,000. They promise to pay you back with interest. Countries around the world bought these bonds, called U.S. Treasury bonds, the way you might put money in a savings account.
Let's face it, the world is addicted to debt. Pretty much every country, okay, leaving Germany aside, has very large amounts of government borrowing.
It was unshakable, reliable, the one thing in global finance you could count on. That's changing. And when the world stops trusting American debt, everything in your life gets more expensive. Here's how we got here in 30 seconds. 2008, financial crisis. America borrowed $700 billion to bail out banks, then another $831 billion for stimulus. COVID hit. Trillions more pumped into the economy. Stimulus checks, business bailouts, unemployment benefits. By 2021, America owed more than its entire economy produced in a year, for the first time since World War II. And the whole time, everyone assumed this was fine because interest rates were basically zero. Borrowing was essentially free. But that era just ended. When Russia invaded Ukraine in February 2022, the US and its allies did something unprecedented. Together, they froze $300 billion in Russian central bank reserves held in Western banks. Most of it sits in Europe. Gone overnight. Every finance minister on Earth watched that happen, and they all thought the same thing. That could be us. You can't unbreak trust. Even if American policies were to change tomorrow, the precedent exists. Future administrations could freeze reserves again. Countries that once saw U.S. Treasury bonds as untouchable now see them as potential political leverage Washington holds over their governments. So they started hedging. Not dramatically, not all at once, but steadily. Now here's where this gets really interesting. Because what happened next, nobody saw coming. China has been selling for years. They've cut their holdings by over 40% from their peak. Even traditional U.S. allies have trimmed their positions at times. The shift is quiet but unmistakable. In 2013, foreign investors held half of all U.S. debt. Today, just 30%. In a single decade, foreign appetite has been cut nearly in half. Here's why this matters more than any other economic story you'll hear this year. Foreign governments buying U.S. debt weren't shopping around for the best deal. They bought regardless of the interest rate because they needed dollars. They needed reserves to back their currencies, to protect against financial crises. They were price-insensitive buyers. But as they sell, someone else has to step in. And that someone is hedge funds and private investors. These are price-sensitive buyers. They only buy when the return is worth the risk. They have options. They can invest in corporate bonds, stocks, or real estate instead. If you're wondering what the difference is, think of it like rental housing. A tenant signing a year lease is price insensitive. They need a place to live, so they commit at $2,000 per month whether market rates rise or fall. But a hotel guest booking nightly? They're price sensitive. They're comparing rates constantly. If your price isn't competitive, they book elsewhere. That shift from locked-in tenants to rate-shopping guests, that's what's happening to U.S. debt right now. The era of cheap borrowing is over. And here's the part that hits your wallet. When the government pays more to borrow, everyone pays more to borrow. Your mortgage rate just increased. Your car loan got more expensive. Your credit card interest climbed. Think about what this means for someone buying a house right now. If rates rise just one more percentage point, that's an extra $250 per month on a typical $400,000 mortgage. Over 30 years, you're paying an extra $90,000. Not because houses got more expensive, because the world stopped trusting America's debt. Government borrowing costs are the benchmark for every other rate in the economy. When Treasury yields rise, everything follows. The entire economy shifts to a higher rate regime. And this shift isn't temporary. The conditions that created those captive foreign buyers are gone. Countries needed to stockpile dollars. They trusted that U.S. reserves were untouchable. That trust broke with the Russian freeze. You can't undo that. That's why higher rates are here to stay. The U.S. government now pays over $1 trillion per year just on interest. Not building roads, not funding schools, not paying for healthcare, just interest on old loans. That's more than the entire defense budget, more than all education spending. $1 trillion vanishes every year just to service debt, and it's only getting worse. Each time foreign buyers retreat another step, rates climb a bit higher. The Congressional Budget Office projects America's debt will hit 122% of GDP within a decade. That assumes current rates. If rates keep climbing because foreign buyers keep leaving, the math gets catastrophic. But this isn't just about interest rates. There's something bigger at stake. For 80 years, the dollar has been the world's reserve currency. This gives America what economists call exorbitant privilege, real benefits that touch your daily life. The U.S. borrows cheaper than any comparable nation. America runs massive trade deficits without immediate consequences because other countries need dollars. You buy cheap goods from China, affordable electronics from Taiwan, all because the dollar's global role lets America import more than it exports. It enables a defense budget approaching $1 trillion without the constraints that bind other nations. But privilege requires trust, and trust, once broken, is nearly impossible to fully repair. Countries aren't dumping dollars all at once. That would devastate their own portfolios. But they are diversifying. Gold purchases by central banks hit record levels last year. Most of that buying happens during Asian trading hours when foreign central banks are active. The dollar's share of global reserves has quietly declined from 72% in 2001 to 58% today. The IMF calls it stealth erosion, death by 1,000 cuts rather than execution by guillotine. Here's the paradox that prevents an immediate crisis. Nothing can replace the dollar. Not yet. The euro represents 20% of reserves, but Europe doesn't have a unified government. There's no European treasury that can issue bonds at the scale needed to absorb trillions in global savings. The Chinese yuan? Just 2% of reserves. China maintains strict capital controls. Money can't freely flow in and out. You cannot serve as the world's bank if investors can't freely access your assets. Gold? Central banks are buying record amounts, but you can't pay salaries in gold bars. It's insurance, not infrastructure. So for now, the dollar remains essential. But essential and trusted are different things. What's most likely is gradual evolution toward a world where the dollar remains important but shares the stage. This is actually the historical norm. Complete dollar dominance after World War II was the anomaly, not the standard. We've seen this transition before. Britain held reserve currency status for over a century. The pound sterling was the foundation of global finance. Then World War I happened. Britain borrowed massively. After the war, investors questioned whether Britain could pay it back. The pound's status eroded gradually over 2 decades. By World War II, the dollar had replaced it. Britain went from superpower to secondary power. The whole transition took about 25 years. America may be entering the early stages of a similar process. So what does this mean for ordinary Americans? If America loses reserve status entirely, interest rates would jump even higher. Mortgages would become more expensive. Car loans, credit cards, all of it costs more. Most importantly, imports get significantly more expensive. That iPhone? More expensive. That coffee? More expensive. Your cost of living takes a direct hit. The government faces brutal choices between defense, Social Security, and Medicare. Programs get cut. Taxes potentially rise. The fiscal squeeze tightens year after year. Some economists argue this is overblown. Paul Krugman says America borrows in its own currency, so it can never default. Japan has debt far higher than America and hasn't collapsed. Here's what that misses. The challenge facing America is real. Print money to ease the debt burden and risk destroying the credibility as a reserve currency, or accept persistently higher rates that strain economic growth. Neither option is appealing, which is why this requires serious fiscal reform. Spending cuts, revenue increases, or both. But reform is politically brutal, and so far, there's little appetite for it. The warning signs are visible right now. Foreign official dollar reserves fell by over $100 billion since September. Yields rising even as the Fed cuts rates. Gold prices surging. Markets are repricing American debt in real time. The era of consequence-free borrowing has ended. What comes next depends on decisions being made right now. Most Americans have no idea these stakes even exist, that the foundation of American financial power is quietly crumbling, that the world is slowly, methodically preparing for a future where the dollar isn't the automatic choice. That ignorance won't last forever. The only question is whether America wakes up in time to do something about it, or wakes up one morning to discover the world has already moved on. For 80 years, America's financial dominance seemed permanent, unshakable. But history shows that nothing lasts forever. Not the British pound, not the Spanish dollar before it, and maybe not the American dollar either. The foundation is cracking. Most people just haven't looked down yet. So here's my question for you. Do you think the dollar will still be the world's reserve currency in 20 years? Or are we watching the end of an era in real time? Let me know what you think in the comments.